Howdy, folks. Day 59 of the Storage 100, and I am Joe Downs with Storage Moguls Mastermind. Today, we're diving into insurance, which is the other silent killer in self storage. You might think you're covered, but many operators are dangerously exposed, and we wanted to cover why insurance is more critical now than ever. Because understanding your coverage can literally save your business. You don't want to let a gap in your policy become a financial disaster. So, let's start by looking at the current insurance landscape. We're in what's called a hard market for insurance, and it's hitting self storage kind of hard. This isn't just a small bump. We're seeing premiums jump 30 to 50%. In the last several years, it's felt like 30% year over year. So, why the massive increase? Well, unfortunately, some of the weather events have been a huge factor in the recent cycle. Hurricanes, fires, severe storms, they've been more damaging in the last few years than they have in previous cycles. And inflation also plays a big role in that because the replacement costs for damaged properties are much higher now. And to make things even tougher, many insurance carriers have left the market. So fewer options means less competition and higher prices. So given this hard market, you need to know the absolute must-haves for your insurance coverage. So first, property coverage is not negotiable. This protects your buildings, roofs, and all your structures. So then there's the general liability, which covers you for things like a slip and fall incident on your property. Also, customer goods and legal liability is crucial. That protects you if your tenant's items are stolen or damaged while in your care. And then finally, sale and disposal liability protects you from wrongful auction items. These four are your foundational coverages. You cannot afford to skip any of them. But even with these, there's a critical distinction you need to understand. The distinction between replacement cost and actual cash value, or ACV, is absolutely vital for your financial survival. Replacement cost coverage pays to build a brand new facility at today's prices, giving you full protection. Actual cash value, or ACV, only pays what your building was worth after depreciation. With ACV, you're getting a partial payout, which means you'll be on the hook for the difference. Always, always, always get replacement coverage. If you've a fire and you only have ACV, it could bankrupt you. This one decision can make or break your business after a major loss. All right, let's talk about a common trap that can derail your insurance efforts. And that's the loss runs. The loss runs report is a critical document and it can be a real trap if you're not careful. This report is the seller's official claims history for that property. If the seller had 3 claims in 5 years, your insurance rate could double. Or worse, you might become uninsurable altogether. You absolutely must get this report during your due diligence phase. Don't wait until closing to discover a problematic claims history. This has to be part of your due diligence. This document directly impacts your ability to get affordable insurance. All right, so how do we estimate property insurance costs? Because it's kind of critical for any self-storage investor. So understanding these numbers early can save you from major financial surprises down the road, certainly during your due diligence. So as a rule of thumb for 2026, you should estimate between 30 and 50 cents per square foot per year. So a 40,000 square foot facility, that's anywhere between 12 and 20,000 annually. But here's a critical point. If you're in a coastal area, you should probably look at doubling that estimate. This isn't just a guess, it's a vital part of your financial modeling. Ignoring these costs can severely impact your profitability. Following up on those insurance costs, let's also talk about a powerful revenue tool for you as the owner, and that's tenant protection, or TPPs. This is a truly secret weapon for self-storage owners, turning a potential expense into a profit center. With TPPs, the tenant pays a monthly fee, typically around $12. After administrative costs, which are usually about $4, you're left with $8 in pure profit. That's a 70% margin and goes straight to your bottom line. This is pure profit and can significantly offset your property insurance costs, making your facility more resilient. It's a smart way to generate additional revenue while providing value to your tenants. All right, now let's look at a real world example of how these insurance costs can impact a deal. So In this example, which we call the Florida surprise, perfectly illustrates the impact of insurance. A student of ours had a seller whose premium was roughly $15,000 a year because it was grandfathered in. However, the buyer's new policy quote came in at a staggering $45,000. This created a $30,000 negative impact on the net operating income. When you apply a 6% cap rate to that NOI hit, it translates to a $500,000 loss in property value. This isn't just a hypothetical, folks. It's a very real scenario that can derail a deal, and this happens all the time. It underscores why you can't just assume insurance costs will remain the same. This leads us to a crucial closing thought about how we approach insurance. Okay, so my closing thought on this topic is simple but profound. Insurance is not a commodity. It's a survival tool for your business, and you need to treat it as such. Don't assume anything when it comes to insurance. Always get a quote early in your due diligence. This proactive approach protects your investment and ensures you're making informed decisions. It's about understanding the true cost of ownership, not just the purchase price. This diligence will save you from costly surprises and protect your financial future. It's saved us quite a few times. Okay, I know, another kind of unsexy but really important one. So if you found this information valuable, please hit the like button so we can reach more investors, grow this community. Tomorrow, we'll be diving into day 60, discussing management fees and how to ensure you're not overpaying. Please subscribe to the Self-Storage Mastermind channel so you don't miss out on that or future daily drops. And of course, our up and coming live, which is right around the corner. And also, share this video with anyone you know who's looking to invest in self-storage. They'll thank you later.